You have probably heard that investing is how ordinary people build wealth. You have probably seen the charts showing how $100 a month becomes $1 million over 40 years. You have probably told yourself more than once that you really need to start. And yet here you are. Maybe you opened a brokerage account 6 months ago and never funded it. Maybe you have money sitting in a savings account earning almost nothing, waiting for the right moment that never seems to arrive. Maybe you have scrolled through Reddit threads and YouTube videos until your head spins with contradictory advice. Each guru more confident than the last, each strategy promising the secret that others are too blind to see. And somewhere in the chaos you froze, not because you're lazy, not because you do not care about your future, but because nobody ever gave you a framework for understanding what you're actually doing when you invest. And without that framework, every decision feels like a gamble. Every choice feels like it could be the one that destroys everything you have worked for, so you do nothing. Or worse, you do something impulsive, chasing whatever headline or hot tip crossed your feed this morning, taking on risks you do not understand in pursuit of returns you cannot predict. And if this describes you, I need you to know something. This paralysis, this confusion, this sense that everyone else knows something you do not, it is not your fault. It was designed this way. Let me explain what I mean. The financial industry makes money when you are confused. This is not cynicism, it is arithmetic. Every actively managed mutual fund charges fees whether it beats the market or not. Every financial advisor earns commissions on products they sell you, regardless of whether those products serve your interests. Every brokerage profits from your trades, which means they profit from your activity, not your results. If you understood exactly what you were doing, if you had a clear framework that let you make decisions confidently on your own, entire industries would shrink. Billions of dollars in fees depend on your uncertainty. And so, the information environment you swim in every day is not designed to educate you. It is designed to keep you dependent, either on experts who charge for their guidance or on your own anxiety, which drives you to make emotional decisions that benefit everyone except yourself. But here is the truth that cuts through all the noise. Investing is not nearly as complicated as they want you to believe. The foundational concepts can be understood in an afternoon. The framework that separates sophisticated investors from confused ones is not secret knowledge available only to the wealthy. It is publicly available information that nobody bothered to teach you, not in school, not in your family, not anywhere in the systems that shaped your understanding of money. And once you grasp this framework, the paralysis dissolves. Not because investing becomes risk-free, but because you finally understand what risk actually means, how to measure it, how to balance it against your goals, and how to build something that makes sense for your specific life, rather than following generic advice designed for someone else entirely. So let us start with the most fundamental misunderstanding, the one that keeps more people poor than any other single mistake, the belief that not investing is the safe choice. It seems to you that keeping your money in a savings account is playing it safe. It seems to you that at least you cannot lose what you have. It seems to you that the stock market is gambling, and responsible people do not gamble with their future. And this belief is so deeply ingrained, so emotionally intuitive, that questioning it almost feels irresponsible. But I need you to sit with an uncomfortable truth. Cash is not safe. Cash is a guaranteed loss in slow motion. And the people who taught you to fear investing never bothered to teach you about the silent thief that was already in your pocket. That thief has a name. It is called inflation. And to understand how it works, we need to take a brief trip through history. In 1971, something happened that fundamentally changed the nature of money itself. President Richard Nixon announced that the United States would no longer convert dollars to gold at a fixed rate. This event, known as the Nixon Shock, ended the Bretton Woods system that had governed international finance since World War II. Before this moment, every dollar was theoretically backed by a fixed amount of gold sitting in a vault. After this moment, the dollar was backed by nothing except the full faith and credit of the United States government. And what this meant in practice was that the government could now create money without limit. The printing press was no longer constrained by the physical supply of gold, and when you can create money from nothing, the money that already exists becomes worth less. This is inflation, the gradual erosion of purchasing power that happens when the supply of money grows faster than the supply of goods and services. Let me make this concrete. If you had put $100 in a savings account in 1990, You would still have that $100 today plus a bit of interest. Let us be generous and say you earned an average of 2% interest over those 35 years. Your $100 is now maybe $200. But here is the problem. The things that cost $100 in 1990 now cost roughly $250. Your savings account did not keep pace. You did not break even. You lost purchasing power, quietly, invisibly, while the number on your statement stayed reassuringly positive. This is the cruel trick of inflation. It does not take your money. It makes your money worth less. And because the number in your account does not go down, you never feel the loss, but the loss is real. Every year you keep significant money in cash, you are falling behind. The question is not whether you can afford to take risk. The question is whether you can afford not to. Now, I want to be careful here, because the point is not that cash is bad. Cash serves an essential function in your financial life. It provides stability. It provides liquidity, meaning you can access it immediately when you need it. It provides psychological peace of mind, knowing that if something goes wrong, you have a buffer. This is why every financial framework worth considering starts with the same advice. Before you invest anything, build an emergency fund. 3 to 6 months of living expenses sitting in a boring savings account, earning almost nothing, and that is exactly the point. The emergency fund is not an investment, it is insurance. It is the foundation that allows you to take intelligent risks elsewhere, because you know that a job loss or a medical bill or a broken car will not destroy you. The emergency fund is what lets you leave money in the market during a downturn instead of panic selling at the bottom. It is what lets you sleep at night, and until you have it, you are not ready to invest. But once you have it, everything changes, because now we can talk about what investing actually is, and this is where most people go wrong. They think investing is about picking winners, finding the next Amazon before it takes off, timing the market perfectly, discovering some hidden opportunity that the professionals missed. And this belief, this fantasy of the brilliant individual investor outsmarting the system, has been carefully cultivated by an industry that profits from your activity. Every stock tip, every hot take, every breathless article about which sector is about to explode exists to get you trading. Because trading generates fees and commissions regardless of whether you win or lose. But real investing, the kind practiced by people who actually build wealth over time, looks nothing like this. Real investing is not about picking winners. It is about understanding categories. It is about recognizing that different types of assets behave differently under different conditions, and that the art of building wealth is the art of combining these assets in ways that balance growth, protection, and access to your money when you need it. These categories are called asset classes, and understanding them is the single most important financial education you will ever receive. Let me walk you through the major ones, not as a list of options to pick from, but as a framework for thinking about what money actually does when you put it to work. We have already talked about cash. Cash gives you stability and liquidity, but loses value over time to inflation. It is essential for short-term needs and emergencies, but terrible for long-term growth. The person who keeps their entire net worth in cash is not being cautious. They're guaranteeing that they will have less purchasing power in 20 years than they have today. Then there are bonds. When you buy a bond, you're lending money to a government or corporation in exchange for regular interest payments and the return of your principal at the end of a set period. Bonds are generally less volatile than stocks, which makes them useful for reducing risk in a portfolio, but they also offer lower returns over time. Government bonds from stable countries are considered among the safest investments in the world because the chance of the United States or Germany defaulting on their debt is extremely low. But safe does not mean risk-free. Bond prices fall when interest rates rise, and bond returns often barely keep pace with inflation, meaning they preserve your money more than they grow it. Bonds are useful as ballast in a portfolio, something that zigs when stocks zag, but they are not the engine of wealth creation. That engine, for most people, is equities, stocks. When you buy a share of stock, you are buying ownership in a company. If the company grows and becomes more valuable, your share becomes more valuable. If the company pays dividends, you receive a portion of its profits. Over the long run, stocks have outperformed virtually every other asset class, returning an average of roughly 7 to 10% annually after inflation, depending on the time period and market you examine. But this return comes with volatility. Stocks can and do crash. Individual companies can and do go bankrupt. The history of the stock market is littered. with the corpses of once mighty corporations that seemed invincible until they were not. And this is where most beginner investors make their biggest mistakes. The fantasy of stock investing, the one promoted by movies and media, is that you can identify the next great company before everyone else and ride it to fortune. And yes, this happens. People who bought Amazon in 1997 and held through every crash and every doubt are now spectacularly wealthy. But for every Amazon, there are hundreds of companies that seemed just as promising and went to zero. The survivors get the headlines, the failures are quietly forgotten. And when you bet on individual stocks, you're making a concentrated bet that this particular company will beat the odds. You might be right, but you might also be wrong, and being wrong with a concentrated bet can set your financial life back by decades. This is why sophisticated investors rarely bet on individual stocks as their primary strategy. Instead, they use something far more boring and far more effective: index funds. An index fund is a basket of stocks designed to track the performance of an entire market or segment. When you buy an S&P 500 index fund, you're buying a tiny piece of the 500 largest companies in America all at once. You're not betting on any single company. You're betting that the American economy as a whole will continue to grow over time. And historically, this has been an extraordinarily good bet. The S&P 500 has weathered world wars, depressions, financial crises, pandemics, and every other disaster thrown at it, and it has always recovered to reach new highs. Not quickly, not in a straight line, but eventually inevitably over time. The beauty of index funds is that they require almost no expertise. You do not need to analyze balance sheets or predict which sectors will outperform. You do not need to watch the market daily or react to every piece of news. You simply buy regularly, hold for the long term, and let time do the work. And this points to perhaps the most powerful force in all of investing, a force that Albert Einstein allegedly called the eighth wonder of the world: compound interest. When your investments generate returns, and those returns generate their own returns, and those returns generate more returns, the growth becomes exponential over time. A dollar invested at age 25 is worth far more than a dollar invested at age 45, not because the return rate is different, but because that early dollar has more time to compound. This is why the most important factor in building wealth is not how much you invest, or even what you invest in, but how long you stay invested. Time in the market beats timing the market. Every single study confirms this, and yet people continue to destroy their returns by trying to jump in and out at the perfect moment, a game that professionals with billions of dollars and armies of analysts cannot consistently win. But stocks and bonds are not the only assets worth understanding. Let us talk about real estate, because property has created more millionaires than perhaps any other asset class, and yet it is one of the most misunderstood investments available to ordinary people. The traditional path to real estate wealth involves buying property, renting it out, and building equity over time as tenants pay your mortgage. This can be extraordinarily powerful. Real estate offers leverage, meaning you can control a large asset with a relatively small down payment. It offers tax advantages. It offers forced savings as every mortgage payment builds your ownership stake. And it offers the psychological satisfaction of owning something tangible, something you can see and touch and improve with your own hands. But direct real estate investment is also expensive, illiquid, and operationally complex. You need significant capital just to get started. You become a landlord, responsible for maintenance and tenant relations, and all the headaches that come with property ownership. And your wealth becomes concentrated in a single asset in a single location, which is the opposite of diversification. For many people, especially those just starting out, there is a better way to gain exposure to real estate without these burdens: real estate investment trusts, or REITs. A REIT is a company that owns and operates income-producing real estate, and by law must distribute most of its profits to shareholders as dividends. When you buy shares in a REIT, you're essentially buying a piece of a professionally managed real estate portfolio. You get exposure to property markets without the hassle of being a landlord, and you can buy and sell your shares easily, unlike physical property which can take months to sell. REITs are not perfect. They are sensitive to interest rates, and their prices can be volatile, but they offer a way into real estate for people who do not have hundreds of thousands of dollars for a down payment. Then there is gold. Gold is perhaps the oldest store of value in human history, treasured by civilizations for thousands of years. And gold still serves a purpose in a modern portfolio, but that purpose is often misunderstood. Gold does not generate income. It does not pay dividends. It does not grow earnings or expand into new markets. A bar of gold sitting in a vault today will be the same bar of gold in 50 years, doing nothing except existing. The value of gold comes from its role as a hedge against catastrophe. When currencies collapse, when governments fall, when financial systems break down, gold tends to hold its value. It is the asset you own for the scenarios you hope never happen, insurance against the worst outcomes rather than a vehicle for growth. For most investors, a small allocation to gold provides psychological comfort and genuine diversification, because gold often moves independently of stocks and bonds. But loading up on gold as a primary investment is a mistake. You are sacrificing the growth potential of productive assets for the security of an inert metal. And now we need to talk about the elephant in the room: cryptocurrency, Bitcoin, Ethereum. The thousands of altcoins that have emerged in the past decade. Crypto has made some people spectacularly rich and made others lose everything they had. And the debate about its future is fierce, with true believers claiming it will revolutionize finance and skeptics calling it the greatest speculative bubble in history. Here is my honest assessment: nobody knows. The technology underlying cryptocurrency, blockchain, is genuinely innovative. The idea of decentralized, borderless money has real appeal, especially to people who distrust institutions, and the returns have been, at times, astronomical. But the volatility is extreme. An asset that can rise 50% in a month can also fall 50% in a month, and has repeatedly. There is no underlying cash flow, no earnings, no dividends, nothing that allows you to calculate an intrinsic value. The price of crypto is entirely based on what the next person is willing to pay, which makes it speculation, not investment in the traditional sense. If you want to own some crypto, fine. Treat it like a lottery ticket. Use money you can genuinely afford to lose without affecting your life. But do not confuse speculation with the kind of steady wealth building that will actually secure your future. The people who became millionaires from crypto either got lucky, got in early, or both. Assuming you will replicate their success is the same mistake as assuming you will win the lottery because someone else did. Finally, at the far end of the spectrum there is private equity. This means investing directly in private companies that are not traded on public stock exchanges. The returns can be extraordinary. Get into a startup before it becomes the next Facebook, and your investment multiplies 1,000 times. But private equity is illiquid, meaning your money is locked up for years. It is risky, because most startups fail. And it is largely restricted to accredited investors, people who already have significant wealth. For beginners, private equity is not a realistic option, and does not need to be part of your framework. It is the domain of the already wealthy, and pretending otherwise is just another way the financial industry makes you feel like you're missing out on something. So where does all of this leave you? With a framework for thinking about investing that most people never receive. Every asset has a profile defined by 3 variables: risk, return, and liquidity. Cash has low risk, low return, and high liquidity. Stocks have higher risk, higher return, and reasonable liquidity. Real estate has variable risk and return with low liquidity. Gold has low return but serves as a hedge against systemic risk. Crypto has extreme risk and potential extreme return with reasonable liquidity. Private equity has high potential return with low liquidity and high risk. And the art of investing is not picking the best asset. It is combining assets in a way that matches your personal situation, your timeline, your goals, and your ability to tolerate seeing your account balance drop without panicking. This is what diversification actually means. Not owning a little bit of everything. Not spreading your money randomly across whatever seems interesting. Diversification means constructing a portfolio where the assets balance each other, where the volatility of one is offset by the stability of another, where you have growth engines for the long term and safety nets for the short term. And here is the crucial insight that most people miss. There is no optimal portfolio. There is only the portfolio that is optimal for you. A 25-year-old with a stable job and no dependents can afford to take more risk than a 55-year-old approaching retirement. Someone with a high risk tolerance who can watch their portfolio drop 30% without flinching should invest differently than someone who loses sleep over a 5% decline. Your goal is not to copy what some expert recommends. Your goal is to understand the principles deeply enough that you can construct something that fits your life. And this brings us to the final point, the one that underlies everything else. Education is the real investment. Every dollar you spend learning how money works will return far more than any stock pick or hot tip ever could. Because when you understand the system, you stop making emotional decisions. You stop panic selling at the bottom and euphoria buying at the top. You stop chasing whatever asset made headlines last week. You stop feeling paralyzed by choices because you finally have a framework for evaluating them. The financial industry profits from your confusion. Your education is the antidote to their business model. So let me leave you with this. The markets will do what they will do. There will be crashes and booms, bubbles and corrections, moments of euphoria and moments of despair. None of this is within your control. But what is within your control is whether you show up prepared, whether you understand what you're buying and why, whether you have a plan that accounts for the inevitable volatility instead of being blindsided by it, whether you have the patience to let time work its magic instead of demanding immediate results from a process that rewards decades, not days. Most people invest without understanding the risk they are taking. They buy assets they cannot explain, following advice from people who profit from their activity, hoping for outcomes they have no framework to evaluate. And when things go wrong, as they inevitably sometimes do, they have no anchor, nothing to hold on to, no reason to stay the course, when staying the course is exactly what they should do. You do not have to be most people. The knowledge is available, the frameworks exist. The only question is whether you will take the time to learn them before you put your money at risk, or whether you will remain one of the confused, the paralyzed, the easily manipulated, forever wondering why building wealth seems so easy for everyone except you. The choice is yours.